You know that feeling when you set your alarm for 6:30 a.m. on a Sunday night and your chest gets a little tighter? That quiet pressure that something is being taken from you. 8 hours, 5 days, forever. There's a specific number where that feeling disappears. Not when you become rich, not when you hit 1 million, a specific number where Sunday nights stop feeling like the end of something. Most financial gurus will tell you that number is 10 million. Some say 5, some say 1. Others throw out the famous 4% rule and pretend the math is that simple. But here's what they're missing. The real number depends on 3 things almost nobody talks about. And once you understand them, you'll realize the answer is smaller than you fear and bigger than the YouTube experts will admit. Your financial advisor won't volunteer this part. Strange. Today, we find the real number, the math, the psychology, and the 3 hidden traps that turn this dream into a nightmare for most people who try it. Stay with me. You wake up at 9:47 on a Tuesday. You did not set an alarm. You did not need to. A notification hit your phone at 6:14 this morning. 127 euros paid to you while you were sleeping. Not from your job, not from a side hustle, from a company in Atlanta that's been quietly thanking its shareholders for 60 straight years. Every quarter, like clockwork. You make coffee, you read for an hour. At 11 o'clock, you take a walk. Nobody is waiting for a report. Nobody is waiting for an email. You are not late for anything. This is what most people mean when they say financial freedom. A specific Tuesday morning that nobody owns but you. But here's the part they never show you. Behind that, 127 euros is a specific math. Behind the math is a specific number. And behind the number are 3 reasons most people will never see this Tuesday morning, even if they try. Let's break it down. The 4% rule is the most famous formula in personal finance. It was created in 1994 by a financial advisor named Bill Bengen. He looked at decades of market history and asked one question. How much can you safely pull out of your investments every year, forever, without running out of money? His answer was 4%. The logic is simple. If your portfolio grows around 7% a year on average, and inflation eats 2 or 3%, you have a small buffer left, 4%. That's the number. So if you want to live on 40,000 euros a year forever, the math says you need 1 million invested. 40,000 euros divided by 0.04. Done. If you want 20,000 euros a year, you need 500,000 euros. If you want 60,000 euros a year, you need 1.5 million euros. Boring formula, powerful idea. Here's the thing. Bill Bengen wrote that rule in 1994. The world has changed a lot since 1994. Interest rates collapsed. Bonds stopped paying. Inflation came back. Stocks got more expensive. The 4% rule still works, but only if you understand the 3 traps that quietly destroy it. Watch this. Trap number 1. Inflation. A loaf of bread in 1994 cost about €1.20. The same loaf in 2024 costs around €3.50. If you retire today with €1 million and you spend 40,000 euros a year, you feel comfortable. 5 years pass. Inflation runs at 3%. Now you need 46,000 euros just to live the same way. 10 years pass. You need 54,000 euros. 20 years pass. You need 72,000 euros. But the math you used to retire, it assumed 40,000 euros forever. The famous 4% rule doesn't care that bread costs more now. This is why most people who retire on dividends run out of money quietly 10 or 15 years in. Not because they spent too much, because the cost of staying still kept moving. The fund manager won't mention this part. Strange. Inflation isn't a tax you can see. It's a tax that takes your buying power one slice at a time every single year while you sleep. Here's what nobody tells you. To live off dividends and not slowly go broke, your portfolio has to grow faster than inflation. which means you can't just hold high dividend stocks. You also need stocks that grow. Otherwise, the math eats you alive. Trap number 2, the yield trap. Meet James. James is 38. He just hit 200,000 euros invested. He's tired of the boring 4% he's getting from his index fund. He wants to retire faster. One night, he finds a stock paying 12% in dividends. He does the math. 12% on 200,000 euros is 24,000 euros a year, 6 times more than what he's making now. He sells his index fund. He buys the 12% stock. 6 months later, the stock drops 30%. The dividend gets cut in half. James now owns a stock worth 140,000 euros, paying 8,400 euros a year. He didn't get richer, he got poorer faster. This is a yield trap. The dividend looks huge because the price collapsed. The company is bleeding. The cash flow that pays the dividend is drying up. The market priced this in. James didn't. Here's the rule nobody teaches you. If a stock yields more than 7 or 8%, something is wrong. The market is telling you the dividend is in danger. The market is almost always right. The boring 4% will outlast every flashy 12% every time. Now, you might be thinking, but there are real high-yield stocks that work. Sure, a few, maybe 1 in 50. The other 49 are James's stock. You will not know which one is which. The professionals don't either. So the math says, stick with boring. Boring wins. Trap number 3. The one almost nobody calculates correctly. Taxes. Let's go back to your million euros. The 4% rule says you can pull 40,000 euros a year. But the 4% rule was written by an American advisor for American investors. It didn't include taxes. In most of Europe, dividends are taxed. In Italy, around 26%. In Germany, around 25%. In France, it can climb past 30% with social contributions. So, your 40,000 euros in dividends? After Italian tax, it becomes 29,600 euros. That's a difference of 10,400 euros a year, every year. To actually keep 40,000 euros in your pocket, you don't need $1 million invested. You need around 1.35 million euros. That's a 35% more than the YouTube video told you. Banks call this withholding. It's a polite name for, we took it before you saw it. Add the inflation trap and the yield trap, and the comfortable €1 million retirement starts looking less comfortable. Here's the truth nobody types out cleanly on a slide. The 4% rule is a starting point, not an ending point. The real number is bigger, and the people selling you the dream rarely show you the gap. So, what's the real number? The one that actually works after all 3 traps? Let's run the math properly. For one person in Europe who wants to live on 30,000 euros a year after taxes, indexed for inflation, with a margin of safety against yield traps. Not the YouTube number, the real one. You need around 1 million euros invested, not in a single high-yield stock, in a diversified portfolio of global dividend-growing companies, the kind that raise their payouts a little every year. Companies like Coca-Cola, Johnson & Johnson, Nestlé, Unilever, the boring giants. 1 million euros across that portfolio, yielding around 3% net of tax, gives you 30,000 euros a year, indexed against inflation because the dividends grow, protected against yield traps because the portfolio is diversified, protected against tax surprises because the math already accounts for them. That's the floor, the number nobody actually quits their job under. If you want 50,000 euros a year after tax, you need around 1.6 million. If you want 100,000 euros a year, around 3.3 million. These numbers are not glamorous. They're not the 10 million to retire headline. They're not the live off dividends with 100,000 euros lie either. They're the actual math. Here's what nobody tells you about hitting that number. You don't celebrate when you hit it. You don't pop champagne. You don't post on Instagram. The day your portfolio crosses 1 million euros, you'll be sitting at your kitchen table on a Tuesday night, eating leftovers, looking at a spreadsheet. You will not feel rich. You will feel calm. The next morning, you'll still go to work, probably for another year, maybe 2. Because the math is one thing, the decision is another. Most people who hit the number wait too long. A few decide too early. The smart ones use the number as a permission slip, not an exit slip. The number isn't the freedom. The number is the option to choose freedom. Buffett still works at 94. He could have stopped at 35. He chose not to. Because once you have the number, work changes meaning. You're not trading hours for survival anymore. You're trading hours for things you actually want to build. Most people work 40 years for a paycheck. The math says you can do it in 12 if you start early and stay boring. 1 million euros doesn't make you rich. It makes you free, which is rarer. The math doesn't care if you believe in it. It just works. Now you know.